Here's the brutal truth that will save your trading account. 95% of retail traders lose money, and it's not because they can't spot opportunities. They lose because they spot too many, while amateurs chase every breakout, every rumor, every hot tip. Like addicts chasing their next fix, professionals understand what Jesse Livermore discovered after making and losing millions 4 times over. The real edge isn't finding more trades. It's finding the right trades with mathematical precision. The stakes are devastatingly real. Risk 10% per trade, and just 3 consecutive losses wipe out 27% of your account. Let me show you the brutal arithmetic. Start with $50,000. First loss takes you to $45,000. Second loss drops you to $40,500. Third loss crushes you down to $36,450. You've lost $13,550 in 3 trades. Most traders never recover from that psychological and financial blow. They either quit or double down with even more reckless position sizes, accelerating their destruction. This is the amateur's death spiral. Emotion-driven entries, oversized positions, and the desperate hope that the next trade will save them. Under stress, your brain seeks relief, not truth. You overtrade. You widen stops. You double position size to make it back. The market teaches you exactly how to hurt yourself. Take 2 traders, both starting with $50,000. Amateur Alex risks 8% per trade because he wants to make it count. Professional Paula risks 2% per trade. Both achieve identical results over 20 trades. A 60% win rate with average winners of 12% and average losers of 8%. Better performance than most hedge funds achieve. Yet after 20 trades, Alex has $47,300. He's down 5.4%, despite being right more often than he's wrong. Paula has $54,200. She's up 8.4%. The difference isn't intelligence. It's mathematics. Professionals operate from a completely different identity. They don't trade their emotions. They trade their edge. When amateurs see a stock breaking out and immediately think, I need to get in. Professionals ask a different question. Is this breakout paying me to participate? The amateur imposes his will on the market. The professional lets the market reveal its intentions first. This identity shift changes everything. The amateur wakes up hunting for the next big move. He's driven by scarcity thinking, believing he must catch every opportunity or miss out forever. He enters positions based on hope, exits based on fear, and sizes positions based on greed. His trading journal reads like emotional warfare. Bought breakout, looks strong, followed by stopped out, manipulation, followed by going all in. This is the one. The professional operates from abundance. He knows markets create high probability setups every single day. He can afford to wait because his position sizing gives him staying power. He enters based on confirmation, exits based on predetermined rules, and sizes based on mathematics. His journal reads like a textbook. Broke pivot at $175.20 on 200% volume. Risked 2% with stop at $172.50. No emotion, no hope, no fear, just mechanical precision. Jesse Livermore understood this distinction after losing his first fortune in 1907. His problem wasn't market analysis. He could read the tape better than almost anyone. His problem was emotional control and position sizing. He was risking too much on individual trades, creating psychological pressure that clouded his judgment. When he rebuilt his fortune, he did so with mathematical discipline that became legendary. Livermore's secret wasn't predicting market direction. It was mathematical discipline combined with what he called pivotal points. These moments when the tape speaks with unmistakable clarity, when confirmation replaces prediction, when the market practically begs you to take the trade. But here's the hidden truth. You can't recognize these pivotal points until you master the foundation that makes everything else possible. Position size is the thermostat for your nervous system. Risk money you can't afford to lose, and every tick against your position feels like a personal attack. Your heart rate increases, your palms sweat, your judgment becomes compromised. You start seeing patterns that don't exist, hearing whispers in market noise, making decisions based on desperation rather than analysis. The 2% edge isn't just about risk management. It's about creating the psychological and financial conditions that allow you to see the market clearly. When you're risking your rent money, you can't think straight. When your position size is controlled, you can wait for the perfect setup. You can watch 10 mediocre breakouts without trading them because you're not desperate to make something happen. This psychological transformation is immediate and profound. The moment you commit to never risking more than 2% on any single trade, your entire relationship with the market changes. You stop being a victim and start being a participant. You stop reacting to every price movement and start responding to genuine opportunities. You stop trading your emotions and start trading your edge. Here's the paradox most won't accept. The best trade is often no trade. Doing nothing is sometimes the most aggressive position you can take. Waiting concentrates your future firepower for the pivotal moment. Professionals call this the patience of capital. When flat, you're not powerless. You're loaded with optionality. But what exactly is that perfect setup? And how do you size it without destroying your account? The answer lies in understanding what Livermore called confirmation with conviction. The specific price and volume patterns that separate genuine breakouts from head fakes. This is where most traders fail, even with proper position sizing. Fear and greed don't start in your heart, they start in your position size. Risk too much, and every tick against you feels like a personal attack. Your breathing shortens. Your time, horizon collapses to the next 5-minute candle. You exit winners at the first sign of profit, and cradle losers like hostages, hoping they'll eventually turn around. This is why most traders fail before they understand what they're fighting. They think their problem is reading charts. Their real problem is mathematics. Here's the mathematical reality that separates professionals from everyone else. Jesse Livermore's 2% rule. Never risk more than 2% of your total trading capital on any single trade, regardless of how certain the setup appears. This isn't conservative thinking, it's compound mathematics working in your favor. Most traders hear this and immediately resist. It sounds too slow, too restrictive, too boring. They want action. They want size. They want to feel the rush. What they get is broke. Let me show you the brutal arithmetic with two traders. Both start with 50,000. 50,000. Amateur Alex risks 8% per trade because he wants to make it count. Professional Paula risks 2% per trade. Over 20 trades, both achieve identical performance. A 60% win rate, with average winners of 12% and average losers of 8%. Better than most hedge funds, achieve consistently. After 20 trades, Alex has 47,000, 347,000, 300 down 5.4% despite being right more often than wrong. Paula has 54,000, 254,000, 200 up 8.4% with identical trading accuracy. The difference isn't skill, intelligence, or market knowledge. The difference is position sizing mathematics that most traders never understand until it's too late. Here's why the math destroys Alex systematically. When he loses 8% on his 50,000 account, he drops to 46,000, 46,000. Now he needs an 8.7% gain just to get back to break even. Lose another 8% from 46,000, and he's at 42,320, 42,320. Now he needs an 18.1% gain to recover his original capital. Each loss makes the mountain higher. Each win barely dents the deficit he's created. This is the mathematical prison most traders build for themselves without realizing they're the architect of their own destruction. Paula's experience operates in a completely different mathematical universe. She loses 2% and drops to 49,000. She needs a 2.04% gain to get back to even manageable and achievable. Her wins compound smoothly because her losses never create mathematical craters that require heroic performances to escape. She's playing a game she can actually win through simple arithmetic progression. The protocol for implementing the 2% rule requires mechanical precision. First, calculate 2% of your total trading capital. A 50,000 account means 1,000 maximum risk per trade. Not 1,000 position size, but 1,000 maximum loss if stopped out. This distinction separates professionals from amateurs immediately. Second, determine your stop loss based on chart structure, never on comfort or round numbers. If you're buying a breakout at 52, 1052, 10, your stop might go at 51, 7, 551, 75, just below the pivotal point that invalidates your thesis. That's a 0. 3, 5, 0. 35 stop distance based on market structure, not your emotional tolerance. Third, calculate position size using this formula. Position size equals risk amount stop. Distance position size equals stop distance, risk amount, with 1,000, 1,000 risk and a 0. 3, 5, 0, 35. Stop. You can buy 2,857 shares. If the math gives you a position that feels too small, understand that your ego is too large for your account size. The market doesn't negotiate with your feelings. Let's make this concrete with a real scenario. You spot a stock consolidating under a 5050 resistance level with rising volume patterns. The breakout trigger is 50, 2050, 20. Your logical stop sits at 49, 40, 49, 40, below the last higher low, and the pivotal point that proves the breakout false. Your stop distance is 0, 8, 0, 0, 80. With 1,000, 1,000 maximum risk, your position size equals 1,000, 1,000 divided by 0, 8, 0, 0, 80, which gives you 1,250 shares. If that number strains the stock's liquidity or feels uncomfortable, you don't inflate the size. You either widen the stop to a more logical level or pass on the trade entirely. Here's the psychological transformation that occurs when you implement this rule correctly. When you can afford to be wrong, you make better decisions. You wait for confirmation instead of anticipating moves. You cut losses without hesitation because 1,000, 1,000 is tuition, not catastrophe. You hold winners longer because you're not desperate to lock in profits before they disappear. This creates what Livermore called the patience of capital, the ability to wait for the market to show its hand instead of forcing your hand on the market. Most traders have this backwards. They're impatient with losses and impatient with profits. They cut winners short and let losers run, hoping for miracles that never come. Consider the psychological states after a loss. Alex just lost 4,000, 4,000. He's angry, frustrated, and desperate to make it back quickly. His next trade isn't based on analysis, it's based on revenge. He sizes up even more because he can't afford another loss. This is how one bad trade becomes a catastrophic losing streak. Paula lost 1,000, 1,000. She's disappointed but not desperate. Her analysis remains clear because her survival isn't threatened. She can take the next good setup without emotional baggage from the previous trade. This is why professionals often have lower win rates than amateurs but consistently make more money over time. But here's where amateurs still fail, even with proper position sizing. They think any breakout above resistance deserves their capital. They see a stock poke above a previous high and immediately pull the trigger. This is amateur thinking disguised as professional execution. Professionals demand something more specific, something Livermore called confirmation with conviction. What exactly separates a fake breakout from the real thing? Amateurs see what they want to see. They spot a stock consolidating near resistance and immediately start planning their yacht purchase. They buy the first poke above the level, then watch in horror as it fades back into the range. Their problem isn't technical analysis, it's wishful thinking disguised as market strategy. They're trading their hopes, not the tape's reality. Professionals see the same chart but wait for something entirely different. Confirmation with conviction. Jesse Livermore's breakthrough came from studying what he called the tape, the actual price and volume action that reveals a stock's true intentions. In his era, traders watched ticker tape machines printing every transaction. Today, we have sophisticated software, but the principle remains identical. The tape never lies, but it requires patient observation to decode its language. Livermore learned to distinguish between a stock merely testing resistance and one genuinely breaking free with institutional force. This distinction separated small losses from large profits, noise from signal, gambling from mathematical edge. Retail traders can push a stock up 50 cents. Only institutions can sustain multi-dollar moves with conviction. Here's the scenario that illustrates everything. Stock XYZ builds a 6-week base between 4848 and 5252. The obvious pivot point is 52. 1052. 10. Where character must change from distribution to accumulation. On Tuesday morning, amateur trader sees the first break to 52. 2. 5. 5. 2. 25. And buys 1,000 shares. Volume is decent at 120% of normal. He sets his stop at 51, 75, 51, 75, and starts calculating profits. By 11:30 a.m., the stock trades 52, 05, 52, 5. By noon, it's 51, 8, 051, 80. He stopped out with a 450,450 loss plus commissions. He curses manipulation, but the market didn't lie, he did. The volume was marginal, not explosive. The penetration was minimal, not decisive. This wasn't breakout, it was probe. The professional watches identical action but sees different information. The initial poke lacks conviction. No institutional accumulation occurs. Wednesday brings another failed probe to 52. 1552. 15 on lower volume. Thursday consolidates between 51, 2, 0, 5, 1, 20, and 51, 8, 0, 5, 1, 80. The amateur might re-enter thinking he's getting a discount. The professional recognizes this as digestion of the failed attempt. Friday changes everything. At 2:45 p.m., XYZ explodes to 53, 6053, 60, a decisive 3% break above the pivot on 300% normal volume. This isn't retail enthusiasm. This is institutional accumulation in real time. Large blocks absorb without pushing price down. Character has genuinely changed, but the professional still waits. Over 30 minutes, the stock pulls back to 52, 8052, 80, and holds for 2 hours. This is confirmation with conviction. The pullback holds above previous resistance, proving 5252 transformed from resistance into support. Volume remains elevated. The tape speaks clearly. The professional's entry protocol requires 5 specific conditions. First, identify the true pivotal point where character must change. This isn't always obvious resistance. Sometimes it's a moving average, gap level, or volume-weighted price that matters most. Second, demand at least 2% penetration beyond that level for normal stocks, 3% for volatile names. This filters probes and head fakes. A stock at 5050 must reach 5151 minimum to qualify as legitimate breakout. Anything less is noise. Third, require volume expansion of at least 150% of the 20-day average. This proves institutional participation. Retail traders can't generate sustained volume expansion. Only institutions moving significant capital create this signature. Fourth, wait for successful retest holding above breakout level. This proves the level truly changed character. Former resistance becoming support is reliable, but only when confirmed through successful retests under volume. Fifth, enter on strength, not weakness. Don't buy the pullback, buy the resumption after pullback holds. This ensures you're buying institutional accumulation, not providing liquidity to smart money. Beware 3 classic fakes. The pre-market news pop that clears the pivot on thin liquidity, only to fade when real volume arrives. The lunchtime drift nudging above the line when participation is low, then rolling over into close. The stop-run spike engineered by algorithms to harvest stops before the true move begins. Each shares identical signature, weak volume on break and immediate failure to hold. This protocol isn't about being right more often, it's about being wrong less expensively and being right more profitably. The 2% risk rule gives you financial freedom to wait for high conviction setups. You can watch 10 false breakouts without trading because you're not desperate to make something happen. Consider the mathematics. The amateur who bought the first probe at 52, 2, 5, 5, 2, 25 lost, 4, 5, 0, 4, 5, 0, and missed the real breakout. The professional who waited entered at 53, 2, 0, 5, 3, 20, when the retest held and rode the move to 57, 8, 0, 5, 7, 80, a 4, 6, 0, 4, 60 profit per share on proper position sizing. The amateur risked 0, 5, 0, 0, 50 per share, hoping to make 2, 0, 0, 2, 0, but his timing was based on hope. His risk-reward looked attractive, but probability was low because he traded noise. The professional risked 0, 4, 0, 0, 40 per share to make 4, 6, 0, 4, 60, and probability was high because he traded confirmed institutional accumulation. Maxim: the stock market never lies, but it whispers before it shouts. Your job is learning to hear whispers through volume patterns, price action, and time. But once you're in a position that's working, how do you maximize the opportunity without turning a winner into a loser? Most traders do this backwards. They see a position moving against them and add more shares to average down their cost basis. This is how small losses become account killers. They buy a stock at 5050, watch it drop to 4747, then buy more because it's cheaper now. The stock falls to 44, and they add again because their average cost is improving. By the time they realize their mistake, what started as a 1,000 loss has become a 5,000 catastrophe that destroys months of careful gains. This is the amateur's death spiral disguised as mathematical logic. Professionals reverse this logic entirely. They add to positions that are proving them right, not positions that are proving them wrong. This isn't intuitive because it feels safer to buy more when price is lower. But safety is an illusion when you're fighting the market's verdict. If the market is telling you you're wrong by moving against your position, adding more shares is like doubling down on a bad poker hand while the dealer shows an ace. Jesse Livermore's pyramiding method was mathematical poetry in motion. He understood that the market's movement in your favor isn't luck. It's confirmation that your analysis was correct and institutional money agrees with your thesis. This creates the perfect condition for increasing exposure, but only under strict mathematical controls that protect capital while maximizing opportunity. Livermore started with what he called his base unit, never more than 2% risk on the initial position. If the market confirmed his judgment by moving in his favor with continued strength and proper consolidation, he would add a smaller position. If it continued proving him right through sustained accumulation patterns, he might add once more, even smaller. But each addition followed rigid rules that separated mathematical precision from emotional gambling. Here's the real example that demonstrates the mathematics. You buy 500 shares of a stock at 5050 with a stop at 4848. Your 2% risk of 1,000 divided by your 2 stop distance equals your position size. This is mechanical calculation, not emotional sizing. The stock moves to 5353 over 4 days, a 6% gain that validates your thesis, but you don't celebrate yet. The critical moment comes next. The stock consolidates for 3 days between 52, 50, 52, 50 and 53, 20, 53, 20, showing institutional accumulation rather than retail profit-taking. Volume remains elevated but not frantic. This is the signature of smart money-building positions, not day traders taking quick profits. You've earned the right to add. You add 250 more shares at 5353 with a stop at 5151. Notice 3 critical elements. The addition is 50% smaller than your base position. You're buying strength, not weakness, and you immediately move your original stop to 50. 1, 0, 5, 0, 10, just above break even. Your original position is now risk-free while your add-on has tight risk control. The stock pushes to 5757 over the next week, again with proper consolidation and volume patterns that confirm institutional sponsorship. You add a final 125 shares with a stop at 5555. Your second position stop moves to 52. 8052. 80. Protecting most of that gain while giving the newest position room to work. The mathematics create beautiful asymmetry. Your average cost is 51. 8, 6, 5, 1, 86 on 875 total shares. Let me show you the calculation. 550 plus 150 plus 120 5 ni 50 plus 120 5 nulis plus trilika 250 plus septini 120 5 410 5 370 5 550 plus 150 plus 120 nol sprelikas 10 septini 25 nulis plus trilika 250 plus septini 120 410 370 divided by 875 shares equals 51. 8, 6, 5, 1, 86. Average cost. If the entire position gets stopped at 5555, you profit 2,747, a 55% return on your maximum risk. If the move continues to 6565 as institutional accumulation suggests, you profit 11,497, a 230% return. But your maximum risk was never more than 1,000. 500 total. And most of that risk was eliminated as stops moved higher with each addition. The pyramiding protocol requires 5 non-negotiable rules. First, only add to positions moving in your favor for at least 3 days with proper consolidation. This filters random noise from genuine institutional accumulation. Day to day, volatility means nothing. Sustained movement, with constructive pullbacks, means everything. Second, each addition should be 50% smaller than the previous. Your base unit might be 500 shares. Your first add 250 shares. Your second add 125 shares. This creates proper risk distribution. Most of your capital enters at the best prices while smaller amounts chase the move higher. Third, move stops to break even on earlier positions when adding. This is non-negotiable. Each addition should make previous positions risk-free, or nearly risk-free. You're not increasing total risk, you're redistributing it across better price levels while the market pays you to get bigger. Fourth, never add more than 3 times to any single idea. Even the best setups eventually exhaust their momentum. 3 positions maximum prevents you from chasing moves into dangerous territory where risk-reward becomes unfavorable. Fifth, if price moves vertically without consolidation, resist the urge to chase. Vertical moves without pause indicate climax buying, the end of institutional accumulation, not the beginning. Wait for proper consolidation that shows smart money is still accumulating before considering additions. Consider the psychological transformation. The amateur who averaged down on a losing position feels increasing anxiety with each addition. His average cost is improving, but his total risk is exploding. He needs a larger and larger move just to break even. He's fighting the market's verdict with hope and prayer. The professional who pyramids winning positions feels increasing confidence with each addition. The market is proving his analysis correct. His risk is contained and often eliminated on earlier positions. He needs only modest continuation to profit handsomely. He's dancing with the market's rhythm, not fighting against it. Here's the subtle edge most miss. Waiting is a position. Doing nothing while your base unit proves itself is not weakness, it's discipline. The tape must confirm continued institutional sponsorship through higher lows above the prior pivot. Diminishing pullback, volume, and time acceptance above former resistance. If those ingredients are absent, you don't add. Patience preserves ammunition for moments that matter. Maxim: never average a loss, always average a winner. This single principle separates professionals from amateurs more than any other rule. It requires emotional discipline to add to positions showing profit when every instinct says to take the money and run. But pyramiding only works when you have ironclad discipline about one final element, knowing exactly when to exit. What's the stop-loss strategy that actually protects your gains while preserving the mathematical beauty of pyramiding? Amateurs set stops, then move them when hit. They turn their risk management tool into a hope management tool. This single behavior destroys more trading accounts than any market crash ever could. You buy a stock at 5252 with a stop at 51. 50, 51, 50. The stock drops to 51. 4551. 45, and you think just 5 more cents and I'll be stopped out for no good reason. You move your stop to 51. 0051. 0. Because the support level looks stronger there. The stock hits 50, 8050, 80, and you move it again to 50, 2550, 25, because you don't want to get shaken out before the bounce. By the time you finally exit at 48, 7, 5, 4, 8, 75, what should have been a 250250 loss has become a 1,625 catastrophe that takes weeks to recover from psychologically and mathematically. Professionals understand that a stop loss isn't a suggestion, it's a sacred contract with yourself and the market. The moment you override a predetermined stop, you're no longer trading a system. You're gambling with hope as your strategy and prayer as your exit plan. This transformation from disciplined trader to desperate gambler happens in seconds, but the consequences last for months. Jesse Livermore learned this lesson through devastating losses early in his career. He possessed exceptional tape-reading skills and could spot pivotal points better than almost anyone. But his early fortunes were built and destroyed by the same fatal flaw: emotional override of mathematical discipline. He would enter a trade with a clear stop, watch it get hit, then convince himself the market was wrong, and re-enter at a worse price. This emotional override of mathematical discipline cost him his first fortune, then his second, and even his third. Each rebuilding taught him the foundation principle that guided his later success: cut your losses short and let your profits run. The lesson became permanent. The faster you recognize you're wrong, the smaller the tuition. Delay is debt. Every extra point you give a loser steals points from your next winner. Here's the professional protocol that actually works. Set stops based on chart structure, never on dollar amounts or percentages. If you bought a breakout above 5252, your stop goes just below 51, 8051, 80 below the pivotal point that made you buy. This placement aligns risk with market structure and keeps random noise from flicking you out. Your position size flows from that distance, not from your comfort level. Risk 2% of equity, calculate the dollar risk, divide by stop distance, and you know exactly how many shares you can hold without lying to yourself. When pyramiding, the stop rules become systematic poetry. You buy the initial breakout at 52, 1052, 10, with a stop at 51, 7, 5, 5, 1, 75. The stock moves to 5454, consolidates properly for 3 days, and you add at 54, 20, 54, 20. Immediately move your original stop to 52, 0552, 5 just above break even. Your base position is now risk-free while your add-on has tight risk control. The stock pushes to 5757 with continued institutional accumulation. You add a final position at 57, 30, 57, 30, and systematically adjust all stops. Your first add stop moves to 54, 1, 5, 5, 4, 15, locking in profit. Your final add has a stop at 55, 80, 5, 5, 80, giving it room to work while protecting against major reversal. The mathematics create beautiful asymmetry. Your average cost is 51,8651, 86 on 875 total shares. If the entire position gets stopped at 5555, you profit 2,747, 2,747. If it continues to 6565, you profit 11,497, 11,497. But your maximum risk was never more than 1,500, 1,500 total, and most of that risk was eliminated as stops moved higher with each addition. Here's the critical moment that separates professionals from amateurs. A sudden reversal hits the stock, and your final ad at 57,3057. 30 gets stopped at 55,8055, 80. The amateur's instinct is to question the stop, blame manipulation, or immediately re-enter because nothing fundamentally changed. The professional accepts the exit mechanically. You exit the final ad but keep the profitable base positions. This is mechanical precision, protecting capital while preserving gains. Most of your position remains profitable, and you maintain the right to reevaluate if proper consolidation resumes. Adopt the two-attempt rule. If a stock stops you out twice from the same general area, you're done with that idea. The market is telling you something important about institutional sentiment or hidden supply. Listen to it. Move on to fresh setups where probabilities are cleaner and your emotional baggage doesn't cloud judgment. Waiting is a position. Waiting costs nothing and earns clarity. Consider the mathematics of discipline versus hope. The disciplined trader who honors stops consistently might have a 55% win rate, with average winners of 8% and average losers of 2%. The stop mover might achieve 70% accuracy by avoiding small losses, but his average loser balloons to 6%, while winners remain 8%. His occasional large losses destroy months of careful gains despite higher accuracy. Maxim: the market can remain irrational longer than you can remain solvent. Honor your stops completely, or they become meaningless suggestions that destroy accounts through death by 1,000 cuts. Your complete system crystallizes. Wait for 2% confirmation at pivotal points. Risk only 2% per trade. Pyramid on strength with mechanical precision. Honor stops without exception. This isn't glamorous, but it compounds wealth, while others compound losses through hope disguised as strategy.